Tim, who started investing at the age of 20 and invests £350 a month with an average annual return of 7%, will end up having approximately £1.3 million at the retirement age of 65 years old. Sally, who waited a bit before getting her act together and started investing the exact same amount at the same annual rate, but waits until she's 35 years old before investing, will only end up with approximately £430,000 at retirement. This is a pretty significant gap between these two final retirement numbers, and the difference is simply that Tim started early. But that's not the only reason you should start investing now. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. Content that we discuss is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. There are many reasons why people are initially reluctant to start investing. In this video, I'll firstly explain why it's better to just get started as early as you reasonably can. Then we'll counter those excuses that people often have, and we'll see why they're simply that, excuses. So why start early if you can? Starting early with retirement investing allows the powerful advantage of compounding returns, where your earnings generate their own earnings over time. This means that even small investments made early on can grow significantly thanks to the exponential nature of compounding. Additionally, being early allows you to spread out your contributions over a longer period, reducing the monthly amount needed to reach your retirement goals. This not only makes saving more manageable, but also provides more time to recover from market downturns, benefiting from the long-term growth potential of investments like stocks. Moreover, starting early fosters better financial habits, helping you develop discipline and financial literacy as you learn and refine your investment strategy. It also allows you to fully utilize tax-advantaged retirement accounts, maximizing your wealth accumulation. Overall, early investing reduces financial stress, offering greater flexibility and security as you approach retirement, ensuring a more comfortable and worry-free future. So, what's holding people back? I'll go through the 3 most common reasons people just don't start investing now, and I'll hopefully counter them as excuses. The first reason, financial instability. The first excuse that people often come up with is that they aren't ready financially or that it's not a good time for their finances due to any number of reasons. Let's see how to address that issue. You can start small. It's a common misconception that you need a large sum of money to begin investing, but the reality is nowadays you can start small and still make meaningful progress. Today, options like fractional shares allow you to invest with just a few dollars, giving you access to even the most expensive stocks without needing to buy a full share. To find money for investing, create a simple budget to identify small amounts that can be redirected from daily expenses. By consistently setting aside even modest amounts, you can begin building your investment portfolio over time. If you're going down this route, then you'll need a low-cost broker that isn't taking a big cut of your deposits in fees. And that's where the sponsor of today's video comes in, Trading 212, my recommendation of broker for most use cases and most users that are likely to be watching this channel. I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. If you've opened an account recently or planning to open an account, then here it is, DivXP or DIVEXP, short for the Dividend Experiment. And you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading 212 for sponsoring this video. Now, starting small will inevitably lead to smaller results at first, but it has a more important effect. Starting small in investing does more than just grow your money, it helps you build a consistent habit of regular investing. This consistency is key to long-term success because it teaches you discipline and helps you establish a routine that you can gradually grow over time. By setting aside even a small amount regularly, you start to develop the skills and mindset needed to manage your finances effectively. Over time, this habit can lead to greater financial stability and the ability to invest more confidently. Starting small also reduces the pressure and fear that often come with investing, which can be a big barrier for most people. When you invest smaller amounts, the risks feel more manageable, and this can make the process less overwhelming. As you watch your investments slowly grow, you'll likely gain confidence in your ability to make smart financial decisions. This confidence can motivate you to increase your investment amounts, further boosting your potential for wealth building. In this way, starting small is a powerful way to ease into investing while setting the stage for long-term financial growth. Balancing investing with debt and expenses. Many people worry that they need to focus solely on paying off debt and covering expenses before they can start investing. And while it's true that high interest debt should be a priority, It's possible to strike a balance between paying off debt and investing for the future. Consider a strategy where you allocate most of your resources towards paying off high-interest debt, while still setting aside a small amount for investing. It's also wise to build or maintain an emergency fund alongside your investments to ensure that you're protected against unexpected expenses. The mathematics will favour the highest interest, and usually that's going to be debt. However, as I just mentioned, there's a psychological value in building the habit in the first place. Investing is a path to financial stability. Whilst you are in a state of financial instability now, investing can actually be the path out of it. Investing isn't just about growing wealth, it's a crucial tool for achieving long-term financial stability. Even small, consistent investments can grow significantly over time thanks to the power of compound interest, turning your modest contributions into a substantial financial cushion. By making investing a regular habit, you can create a safety net that supports future financial needs, from unexpected expenses to retirement. This approach helps build a solid foundation for financial security, ensuring that you're better prepared for whatever the future holds. Reason 2, you feel like you have a lack of knowledge or experience. You don't know what you don't know, and investing can be quite daunting due to the fact that it has real-world consequences with your money. Let's address this reason people don't get started investing. Understanding the basics is easier than you think. Investing can seem like a complex and intimidating world, but the basics are more accessible than you might think. The key is to start with simple investment options that are easy to understand, such as index funds or ETFs, which spread your money across a variety of stocks, minimizing risk. To build your confidence, take advantage of educational resources like books, podcasts, or beginner courses that break down investment concepts into understandable pieces. There's a lot of information out there, and a lot of it you simply won't need immediately when you start out. You don't have to be an expert. It's important to realize that you don't need to be a financial expert to begin investing. In fact, many tools are available that can do much of the heavy lifting for you. Robo-advisors, for instance, create and manage a diversified portfolio based on your financial goals and risk tolerance. Similarly, target date funds adjust your investments automatically as you approach your retirement date. Starting with small amounts and gradually increasing your investments as you learn will help you grow your knowledge and portfolio simultaneously. Learn from mistakes. Like in everything, mistakes are part of the process. Making mistakes is a natural part of the investing journey, and it's important to embrace them as learning opportunities. Don't be discouraged by short-term losses or errors. What matters most is staying focused on your long-term goals. Many successful investors have made mistakes along the way, but used those experiences to improve their strategies and build wealth over time. By keeping a long-term perspective and learning from your missteps, you'll be better equipped to make informed decisions in future. What if you left it to later in life? Are you doomed? Now you might think that you're too old to start investing, or it's too late and you've missed out on your opportunity. It's natural to feel concerned if you haven't started investing as early as you might have liked, but it's important to remember that it's never too late to begin. While starting early offers certain advantages, such as more time for compound growth, starting later still has its own benefits and opportunities. First, any investment is better than none. Even if you start later in life, you can still accumulate wealth over time. The key is to maximize the time you have by investing regularly and strategically. Focus on making the most of your current financial situation, whether that means contributing more aggressively to retirement accounts, or seeking out investments that align with your risk tolerance and time horizon. Second, being older often comes with the advantage of financial stability and a clearer understanding of your financial goals. You might have a better idea of your retirement needs, and with fewer years ahead, you can focus on creating a tailored plan that addresses those specific goals. This can involve a mix of safer, income-generating investments along with some growth-oriented ones to help your money continue to grow. Lastly, remember that investing is about making your money work for you, regardless of when you start. Even later in life, investing can help you build a more secure retirement, generate passive income, and leave a legacy for your loved ones. The best time to start investing is always now, no matter your age. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!